Hi everyone, so I'm hoping this can be the last one for CGT. Where we finished off in the previous video is we looked at certain paragraphs that dealt with certain types of exemptions from CGT. The last one we did was we looked at paragraph 62 and we spoke about the fact that you can ignore any gains or losses on any donations that you make to certain types of PBOs and certain types of exempt entities, such as government or recreational clubs, political parties, things like that. You could ignore 63A, 63B, 64, and 64A. And then we move away from exemptions to what's called rollover relief. Now, rollover relief is a way of deferring your CGT liability. It's a way of taking any kind of gains that you have and not taxing them now, taxing them in the future. So we're going to look at three different ways that this happens. Okay. Firstly, 64B, you'll cover part of it in GDA, the rest of it, as well as C, D, and E, speak about headquarter companies and stuff like that. We're not going to do that. What we are going to do is look at these, 65, 66, and 67. What we have here, starting in 65, is an involuntary disposal. So you have the option to apply 65 if you want to. You don't have to. And it applies when you have a disposal due to operation of law, theft, or destruction. So if something is stolen, destroyed, or taken away due to law, and you receive proceeds, and proceeds are bigger than or equal to base cost, so there is a capital gain, or there's actually nothing, which doesn't work if there's a capital loss. You use all the proceeds to acquire a replacement asset, and you conclude everything within 12 months after the disposal, and you bring in the replacement assets within 3 years after the disposal. The effect, what you are going to do, if it is a non-depreciable asset, disregard any capital gain until the replacement asset is sold, and if it is a depreciable asset, recognize any capital gain pro rata the same as wear and tear. Straight away you should be thinking, hey wait, this is the same as section 8.4e, and it is. Section 8.4e actually only applies when you elect para 65 or 66 in certain circumstances. Okay, so just like you deferred the recoupment, you are going to defer the CGT as well. If you have situations where there's more than one replacement asset, okay, the capital gain must be apportioned between the replacement assets based on the amount of the proceeds spent. Please note, I do realize it says capital gain. It's meant to say capital gain. I also know every year I make that joke because every year for some reason I forget to change it to gain. Maybe subconsciously I leave it there on purpose, who knows. And if you sell the replacement asset before it's fully written off, you recognize whatever is left of the gain straight away, just as you would whatever's left of the deferred recoupment. So it works in pretty much an exact way. There is an example. Okay, this is an example about allocation of gain across multiple replacement assets. So like we said, if there's more than one replacement asset, the gain must be apportioned between them. I then give you an example of rollover relief where an asset was destroyed in a fire. Okay, I think that's quite nice and straightforward. It comes from the textbook. Good. 65B you can ignore. 66 speaks about voluntary disposal. So it's where you take one asset and you use it to replace the other one. Okay. Certain requirements, both assets have to qualify for wear and tear. Otherwise, the requirements are similar to 65 and have similar effects of 65. Okay, so this is a voluntary one, not because of destruction or theft or something like that. In this case, it only applies to assets that qualify for allowances. Now, 67. If you go and look in your acts, you will see that para 67 actually no longer exists. It used to. This is where you used to find it. It's now been moved, and it's no longer in the 8th schedule. It's actually found in section 9HB, like the HB pencil. Maybe that'll help you to remember it. Section 9HB of the Income Tax Act. And this is for transfers between spouses. We spoke about this earlier, and we said if there is a donation or sale to connected person at low market value, this will override it. This does. It says if it's a transfer between spouses, you ignore any gain or loss. So there's no gain or loss for transfer between spouses. And what happens is that one spouse steps into the shoes of the other spouse. They're deemed to have the same acquisition date and the same cost and use it in the same manner. So you just inherit everything from the other spouse. So if husband bought it 5 years ago for $100, gives it to wife, you deem the wife bought it 5 years ago for $100 when she sells it. Okay, so it just treats the two spouses as the same. Some stuff just to note in terms here, where a person dies and assets are transferred to spouse in terms of a will, okay, it will now be dealt with in terms of section 9HB, so the same thing as above, but 9HB does not apply for disposals to a non-resident spouse. It only works if your spouse is South African. You can ignore the following ones that are on screen. Okay, you can ignore 67B, 67C, 67D, 68, and 71. You do need to know 69 to 70 and 72 to 73. They work in the same manner as the attribution rules found in section 7, which we've spoken about a little bit, but we'll deal with in a lot more detail when we do a section on trusts. So for now, you can park them, but make a note when you look at trusts, come back here. Para 75 deals with distributions in specie. So that is when a company distributes an asset instead of cash. They're deemed to dispose of it at market value. Okay, and the company is, the company disposes of it market value and the recipient receives at market value. 76 and 76A you can ignore. 77 is when a company is liquidated, a shareholder is deemed to dispose of the shares on the date of the dissolution, so the date the company is liquidated, and your proceeds would be any kind of things you receive. So if there is a liquidation dividend, that would be your possible proceeds. Okay. Para 80 onwards will be covered in the trust section, and para 97 is not applicable to you guys. So you think that's where I'd end it, but there's one more thing that I need to bring in that I think is quite important. It's not found in the 8th schedule. It's found in section 9 cap C of the Income Tax Act. And what this section says is any amount received by or accrued to a taxpayer or any expenditure incurred in respect of an equity share. So very important. Anytime you have an equity share, it shall be deemed to be of a capital nature if you have held it for a period continuously of at least 3 years. Okay. Now, what this means, I want to be very clear, so I'm making it large. It's when you know you have to listen. What this is saying, if you hold any type of equity share for a period of 3 years, it automatically becomes capital in nature. Okay. The process that you use to get it there is any previous deduction that you would have had gets reversed out, and it then becomes capital. But now what you need to think about is certain things. If it's more than 3 years, it's automatically capital. I'm saying this very, very clearly. It does not mean if it is less than 3 years, it is automatically revenue. Okay. If you are a person just investing in shares and it is not your trade, those shares will be capital regardless of however long you hold them for, because they are capital in nature. What 9C is speaking to is it's speaking to share dealers, share traders, where the shares are revenue in nature because they are trading stock. What it's saying here is if you hold the share for more than 3 years, then it becomes capital for those share traders. And the reason you have this is share traders often use the argument and say, this is our trading portfolio, this is our investment portfolio, and it can get a little bit iffy for that share trader, what's revenue, what's capital. This 9C tells you straight, if you've held it for 3 years, it becomes capital. If you hold it for less, it's going to probably be revenue, unless you can argue it as capital in its own right. But automatically, as a share trader, anything you've held for 3 years becomes capital in nature. Does not apply to people for whom it would have been capital anyway. How you get there, okay, this process, the example of crocodile and ostrich from the textbook shows you, all right, what you're going to have. I'll go back there. Because it's trading stock, you would have had an opening stock deduction. On the moment it hits 3 years, what you do is you reverse that adjustment under 9C, so you add it back. And you now pretend that 150,000 is capital. It's your base cost. You have your proceeds, the difference capital gain, 80%, pop it in, and you're good to go. So that, after quite a few videos, concludes CGT. What I want you to do is to work through, or I'm saying this at the end, I said it at the beginning, but I'll say it again. If you've got here and you haven't understood anything, please take a pause, watch it again, use the textbook, Google stuff, make sure you understand it, and then start attempting some questions. Okay. There's going to be uploaded some further examples about CGT that you should work through. And yeah, I think that's going to be used to determine how your CGT is going. How CGT usually fits in is calculations. There's going to be assets of various types that are going to have certain types of exemptions. What I want you to care about the most is definitely going to be your approach, your format, making sure that you're not adding in CGT multiple times into a calculation, making sure you wait until the end before you add it all up, using the right rates, using the right exclusions, and not doing anything silly like doing something which is capital twice as capital and as revenue. But I know you guys are going to do great. So if you've got to video 8 of CGT, you're probably going to be fine anyway. But yes, all the best for the next few videos.